600 million after making provision for a discount of 40 million. Number 5, your total property, plant and equipment had a carrying amount of 4,800 million and a tax base of 4,000 million. Some rented buildings were revalued upward by shillings 200 million during the year which ended 30th September 2019. 6, intangible assets comprising of trade licenses being amortized over 5 years had a carrying amount of 240 million. This was allowed for tax purpose in full 2 years ago. So number 7, assume a tax rate of 30%. So what are we required to do here? 1, we are required to compute the relevant temporary differences. And Roman 2, we are required to make the journal entries to record the changes in the deferred tax liability. So we start with Roman 1. And in Roman 1, what are we required to do? We are required to compute the relevant temporary differences. The relevant temporary differences. The relevant temporary differences. Temporary differences. Temporary differences, remember, we have referred to this as what? Or actually, this is abbreviated as what? As the TD, the temporary differences. Now, what you have to recall is how do we compute this temporary difference? How do we compute the temporary difference? So we compute the temporary difference by taking the carrying amount of either an asset or a liability. Yes, so I want us to start on this topic here, IS 12, deferred tax, or basically deferred taxes. And first of all, if you can be able to recall what you covered in financial reporting and analysis, you did this topic, the topic on income taxes. And maybe just a quick recap on what you covered in financial reporting and analysis. 1, clear from your side, investment in equity instrument, and the entity intended to retain ownership of those shares for a long period of time. So we have, that's the first type of financial asset. And then we also have the other one, financial asset at fair value through profit and loss. You can write that in full, but remember still these are the abbreviations we used in the previous class. Now, what we need to do as far as these two assets are concerned, we need to identify the year carrying amount. We need to know the year tax base. In most of these particular, or actually these particular questions for deferred taxes, this value is always given by the examiner. In most of the cases, the examiner will give you the carrying amount, but the challenge is always here, how to determine the tax base. But if you can be able to recall, you have said the tax base is the value of an asset or liability for a tax purpose. So therefore, before even we come here to determine the carrying amount, to determine the tax base, I would just want to guide you. How do we determine these two values? How do we determine these two values? I'll be able to give I'll give some notes here, which will also assist in answering other questions. For deferred taxes. So notes. So one is regarding financial assets. Mostly these two financial assets at fair value through other comprehensive income, and financial assets at fair value through profit and loss. So what is the carrying amount? So remember the carrying amount, this is the value at which these assets are recorded in the statement of financial position. If you can be able to recall what we discussed in the previous topic, we say that these two assets, as the name suggests, they are recorded in the statement of financial position at their fair value. The carrying amount is always equal to the fair value at the year end. We record them in the statement of financial position of the company at their fair value. What about the tax base? The tax base for this financial asset is always equal to the cost. Because if, for example, the company owns this particular financial asset and the company sells those financial assets, and we want to know the amount which will be treated as taxable incomes or taxable expense, not taxable expense, sorry, the taxable income or allowable expense, we take the amount at which the financial asset has been sold at, we less the cost. So that means in taxation, when computing the amount to be taxed, when computing the amount to be allowable, what do we use in computation of that? Is it the fair value or the cost? We use the cost. So that's why we're saying the tax base is the cost. The fair value is the carrying what? Amount. So having known that, then this one becomes quite simple. Let's go back to point 1. In point 1, we are told the company has available for sale financial asset with a carrying amount. Carrying amount is already given here, 80 million. And a financial asset at fair value through profit and loss of 40 million. 40 million still, that is the carrying amount. That is the carrying amount or the fair value, the carrying amount or the fair value. And then in the last paragraph, we are told both financial assets reported losses in the fair value of shillings 8 million each during the year. So it basically means that both of them reported losses. If they reported losses, it basically means that the fair value reduced. If, for example, the company had acquired this maybe at 100 million, and you're told it reported a loss, then it automatically means that the fair value for this financial asset reduced. So therefore, if in this case, we are told that this financial asset reported a loss, can we be able to determine the cost? Can we be able to know the amount which the company incurred in buying this financial asset? Can we be able to know the amount which was incurred by the company in buying this asset? I'm told by Kennedy, yes. How do we determine the cost? Because now we know this is their current market value, which has already reduced with 8 million each. Yes, for us to be able to determine the cost, the amount which was incurred by the company in acquiring this financial asset, for this one, we will take 8, we add the loss because its value reduced by 8. So the cost which was incurred, this is now the cost which was incurred was 8 million, and the cost incurred in buying this will be 40 plus 8, which will give us 48. So that will be the tax base, 8 and 48. And then we compute this one, tax base. Remember, tax base, sorry, not tax base, sorry, but temporary difference. This is equal to carrying amount minus tax base. So this one, carrying amount, this is tax base. This is tax base. So that will give us what? This minus this will give us what? Will give us -8. Is that what you're getting? -8? This minus this will give us -8. -8. And because these are negatives, if you can be able to recall, we have said that we have 2 types of temporary differences. We have said we have something called the taxable temporary difference. We have something called the deductible temporary difference. So we have said a temporary difference is taxable, whereby the carrying amount is more than tax base. In other terms, if you get a positive figure here, that is a taxable temporary difference. But if you get a negative figure, it's a deductible. So therefore, this, because it's a negative, is a deductible temporary difference. This one is a deductible temporary difference. And basically, we are done with that point number 1. Are we together up to that point? If you have understood what you have done here, I want us to move to point number 2. Is that clear? Is that clear? Is that clear? Okay, so let's move now to point number 2. In point number 2, we are told inventory is shown at the row of the cost and net realizable value. So what you're given here is inventory. Still, remember, inventory is an asset. These are assets held by the company for sale. Assets held for sale. How do we determine the tax base? How do we determine the carrying amount? Let me give a note for that here. Inventory. The first thing we need to recall is that inventory here is valued in accordance with IS2, International Accounting Standard number 2. This is the standard which guides the company how to determine the value of inventory. So according to IS2, inventory is always valued at the lower of 2 values. 1, the cost, or number 2, the net realizable value. So meaning that the value or actually inventory one is a current asset. We record the inventory in the statement of financial position at the roll of these two. So meaning that the roll of these two is basically the carrying amount. So the inventory